up today, and these problems are related to joint arrangements, or you may have joint operation, joint operation, unincorporated. We have joint operation, proportionate share. Now, shall we begin with problem number two? So you will not find it hard to write. You can just pay attention well. I have published the solutions to the straight problems in for chapter 9. So naka-PDF siya for straight problems 2, 4, 6, 7, and 8. So will you just refer to your canvas and just focus instead of writing? Okay? But you have to be alert because there are some items that I am giving computations. Actually, if I write, hindi kin makuha ni canvas. So anyway, just continue. We are going to begin with problem 2. We already finished problem 1 yesterday or the other meeting. Now in problem 2, this is in connection with a joint operator, proportionate share, reporting proportionate share of the assets, liabilities, revenues, and expenses of the joint operation. X Incorporated, Y Company, and Z Incorporated sign an agreement to collectively purchase on all oil pipeline and to hire a company to manage and operate the pipeline on their behalf. So we have now what we call a vehicle, no, to manage. The costs involved in running the pipeline and the revenue earned from the pipeline are shared by the three parties based on their ownership percentage. All major operating and financing decisions related to the pipeline must be agreed to by the three parties. The cost of purchasing the pipeline was 60 million. The pipeline has an estimated 20-year useful life with no residual value. The management fee for operating the pipeline for 20x4 was 12 million. Revenue earned from the pipeline in 20x4 was 19,800 or 19,800,000. X invested 18 million for a 30% interest. So, if the interest of X is equivalent to 30%, meaning the total interest in the pipeline is 60 million. That's actually the investment in the pipeline. Now, requirement in number 1, prepare entries in the books of X for 20x4 to capture or recognize its share of the activities related to the oil pipeline. So, for our requirement number 1, we have now the first entry to debit, oil pipeline for 18 million and to credit cash. Now, actually, we are asked to prepare the entries only of X. Okay? So, we have now the investment of X of 18 million. Then we also debit oil pipeline operating expenses. 30% of that will be paid by X. So, 3,600,000 credit to cash. Then, for the revenue of the joint arrangement, the revenue is 19.8 million and X will receive 30% of the amount. So 5,940,000 debit to cash and credit revenue from oil pipeline. Then the next entry is to debit, amortization expense for the pipeline, and to credit, accumulated depreciation of the oil pipeline. Now, X investment, that's equal only to 30% of the total cost of the pipeline, is 18 million, and divide it by 20 years. So annually, the accumulated depreciation of the pipeline is 900,000. So you may debit it to depreciation expense or amortization expense for the pipeline, and to credit accumulated depreciation. Compute the share of X in the net income of the joint operation. So we now have the total net income of the joint operation. So we have now the column total 100% base, and we have the 30% proportionate share of X. The revenue of 19.8 million, the share of X, as stated in our journal entry, is 5,940,000. And then we deduct the operating expenses. The share of X in 12 million is only 3.6 million. Again, it's 30%. And then for the depreciation of the pipeline is 900,000. And we now get 900,000 as the result of dividing the share of X, or his investment of 18 million, divided by 20 years, no? So it's supposed to be 900,000. Based on the total, the annual depreciation is 3 million. So we now get the total revenue. We deduct the expenses. Total share of X is 4.5 million. There must be a single line. Draw a single line under 5,940,000 and under 19.8 million, so as to separate the revenue from the expenses. So we have the expenses, share of X of 4.5 million deducted from the revenue. The net income of X is 1,440,000. Based on the total revenue is 19.8 million, draw a single line, and then the total expenses of 15 million. The difference, that's the net income of the joint operation of 4.8 million. 30% of that will go to X. So the net income of X is 1,440,000. Okay, we go to problem number 4. Actually, I did not assign this. However, I I partially discussed this with the afternoon class since we still have time. So, okay na lang. So, problem number 4, again, joint operator, proportionate share. Reporting proportionate share of the assets, liabilities, revenues, and expenses of the joint operation. January 1, 2024, entities J, K, L, and M and N, so 5 of them. The joint operators jointly buy a jet aircraft for 12 million cash. The operators are registered as equal joint owners of the aircraft. They enter into an agreement whereby the aircraft is at the disposal of each operator for 70 days each year. So 70 times 5 of them, meaning 350 days during the year. The aircraft is in maintenance for the remaining days. So that's after 350 days. Uh, the operators may decide to use the aircraft or, for example, lease it to a third party. Decisions regarding maintenance and disposal of the aircraft require the unanimous consent of the operators. The contractual arrangement is for the expected life of 20 years of the aircraft and can be changed only if all the operators agree the residual value of the aircraft is zero. Okay? Uh, in 20X4, the operators each paid 120,000 to meet the joint cost of maintaining the aircraft, such as hangar rental and aviation license fees. So, in 20X4, each operator also incurred costs of running the aircraft when they made use of the aircraft, such as J incurred cost of 60,000 on pilot fees, aviation, fuel, and landing costs. In 20X4, entity J also earned a rental income of 456,000 by renting the aircraft to others. 1. Prepare entries on the books of joint operator J to reflect the above transactions. And 2. Compute the share in net income of entity J in the joint operations. So our entry number 1 now for problem 4 is to debit property, plant, and equipment, interest in an aircraft, and credit to cash for 2.4 million. The total cost of the aircraft of 12 million divided equally by the 5 operators. So that's to recognize the purchase of an ownership interest in a jointly controlled aircraft. In 20X4, now we have the debit to cash for 12 million. That's the correct amount there is not, it's not 12 million, but the correct amount is 456,000. Now please make corrections. Debit to cash 456,000 and credit to profit or loss. Debit to cash, 456,000 and credit to profit or loss, that's from rental income. To recognize income earned in renting to others the use of the aircraft in 20X4. Second entry is to debit profit or loss, aircraft operating expenses, 180,000, and to credit cash for 180,000 to recognize the cost of running the aircraft. Now, that's actually 180,000 is the sum of 120,000 and 60,000. So, 120,000 and 60,000. Then, the next entry is to debit again. Profit or loss for depreciation expense and to credit accumulated depreciation for 120,000. The accumulated depreciation interest in an aircraft is equal to 12 million divided by 20 years, and you divide that by 5. Or you can simply divide 2,400,000 the equity of J, and then you divide that by 20. That will still give you 120,000 for your depreciation expense. Okay? So these are your entries in problem number 4. Now we go to problem number 6. Now in problem number 6, we are required for uh, determine the joint operations net income or loss. And number 2, the cash settlement between joint operators. Indicate the amount of cash settlement and the manner of payment. Okay, now I'll read through problem number 6, at least to give us the details of the problem. We have joint operation entity, partnership in nature. AA, BB, and CC agreed to sell construction tools for a period of 1 month. So this is only a short time venture. AA agrees to construct a stand on the front of the loan of CC. CC will be paid 3,000 for cleaning up the loan after 1 month selling period. AA, BB, and CC decide that net income, if any, will be allocated first by the 3,000 payment to CC, that's for the loan, and then by a 40% commission on individual sales. The balance will be distributed 75% to AA and 25% to BB. They agree that a cash box will complicate the matters and that all purchases and sales transactions will be out of pocket and the responsibility of the individual. Sales to AA, BB, and CC are to be at cost except that the ending inventory may be purchased at 50% of cost. All other sales are to be made at 100% markup on cost. The activity of the joint operation is as follows. AA construct the stand on the front loan at a cost of 12 million. AA pays for 120,000 for various construction tools. CC pays 6,000 for permit to operate the concession or business. AA purchases additional construction tools for 180,000 using 60,000 contributed by BB and 120,000 of personal money. D. Sales for the period where AA, BB, and CC. And E, CC pays 10,000 for office supplies, and these are distributed equally between the three for their personal use at home. CC agrees to pay 6,000 for the stand. So you will notice that the amounts paid are by CC are minimal, only for the permit to operate, only for the office supplies, and for the stand. Now, the rest of the capitalization were financed by the two, AA and BB. That's why if you will notice that the balance of what profit or loss remains will go to AA 75% and to BB 25%. No more to C except that he will be given 3,000 for cleaning the loan. And the balance of construction tools inventory was taken by AA. Now we have the determination of the net income or loss for the period. Now in problem number 6, we now begin with, okay, we now begin with letter A. Let's follow the activities of the joint operations. In letter A, we now debit to investment and credit to AA. Meaning AA was the one who paid for it or contribution of A. Then in letter B, AA pays 420 for various construction tools. Now, actually, this is the inventory item. The inventory item because they will be selling construction tools. So, the entry there, we now debit to investment in joint operation, 120,000, and again credit to AA. Okay, so next we have 6,000. 6,000 for permit to operate was paid by C. So we now debit to investment 6,000 and credit to CC. Now it's just like crediting capital. Then in letter C, AA purchase additional construction tools for the debit to investment in joint operation, 180,000. And then we credit 120,000 to AA for his personal money and credit to BB for his contribution in buying the inventory. Okay? Then for DD, sales for the period. So we now debit to AA, debit to BB, and debit to CC. Now credit to investment in joint operation for the total of 588,000. Take note, debit is just like debiting A, B, C capital and credit to investment in joint operation. Now, in letter E, CC pays 10,800 for office supplies, and these are distributed equally between them for their personal use. So, we now debit to AA, debit to BB, and debit to CC, but we also credit to CC. Actually, this will no longer pass through the investment account because these were distributed to the parties or to the operators for their personal use, but they owe this to CC. Then in letter E, another transaction in letter E stating that CC agrees to pay 6,000 for the stand. So again, we are going to debit CC for 6,000 and credit against the investment in joint operation. So agrees to pay 6,000 for the stand. So it's just like CC buying the stand. The activity is already through. Then the stand remains. So CC agreed to buy it. Then in letter F, the balance of construction tools inventory was taken by AA. Now, how much was the balance in letter F? We now have credit to investment and we debit that to AA in the amount of 3,000 pesos. Now, how did we compute? It's given there. Purchases, 300,000. Actually, 300,000 is the sum of 120,000 in and 180,000 in B and C. So that's equivalent to your purchases. And then the cost of goods sold of 294,000. That's taken by dividing 588,000 by 2, or you multiply 588,000 by 50%. Since the problem stated that your sales may be made here, sales are to be made at 100% markup on cost. So in other words, your cost is 100% and the markup is 100% so that your sales amount is double the cost. So that your cost is 588,000 divided by 2 or times 2. That's equivalent to the amount of 294,000. That's your cost of goods sold. Now, if your purchases total 300,000 and the cost of goods sold is 294,000, the ending inventory is 6,000 at cost. And it stated that the ending inventory may be purchased at 50% of cost. So that if the ending inventory is 6,000 and this was purchased by by A, as stated, the balance in letter F, the balance of construction tools inventory was taken by AA. So we only have the amount of 3,000 as stated. The ending inventory will be priced at 50% of cost. So it was now debited to here the amount of 3,000 debited against AA and credited to the investment account. Okay? So we have now the amount of 3,000 as debit to A and credit to investment. Okay, so finally, we have to determine the net income of 297,000. Okay? So, why 297,000? If you have your sales is equal to 200 no sales is 588,000 and then your cost of goods sold of 294,000. You have a difference of 294,000. Okay? Then you have your expenses. What are these expenses items? If you look at the determination of your expenses, we have now for 12,000. That's the cost of the stand, 12,000. However, it was bought by A, no? The stand was bought by CC. So we have the cost of the stand without any recovery.